You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. So we took a little bit of a break over the 4th of July. Mark and I went back and we did answer a few questions from back in the day and had a little session from the listeners, which I'm hoping that we can get together and do that again soon. One thing that did happen over that little break is we did a trade in Boeing. We did a calendar spread in Boeing. And once again, whenever we talk about strategies on Options Playbook Radio, we're just looking at scenarios that make sense. We don't necessarily have an opinion on the underlying stock. We're just trying to learn. Everything's meant to be a paper trade. But the trade that we looked at, Boeing, turned out well. The market actually was very cordial while we were away for the 4th of July. And if you look at it, I'm just going to recap the trade because I think it's worth talking about because there were some options by the way the underlying moves. So the last time that we looked at that strategy, it was June 28th. Boeing had just been beaten up because of the trade wars that Trump had fired up. And the underlying was trading at $330. I'm just going to round off on that underlying. We noted that they were going to be announcing earnings on the 25th of July. We had a little bit of pumped up volatility because the market had been beaten up. So we had near-term options that were kind of jacked up on volatility, and we had further-term options jacked up on volatility because they were going to announce earnings. We were hoping that the vols would come in the near term, and then they would increase on the far term. So it was, like I said, once again, in Options Playbook Radio, it's always just about looking at opportunities where the options market might fit the strategy, not necessarily the underlying. And what happened with Boeing, so if I just pull up a chart here on the Ally Invest platform, and I see since we had the taping of the show, the markets were open on that day, June 28th, the market really hasn't dipped down below 330. So the stock traded between 330 and 340. It was just what you would like to see happen, basically, if you're going to do a time spread. So there would have been many opportunities to get out. But we did say on the show, if it ever hits the short strike, you want to get out of the trade. Without a doubt, you just always get out of the trade. If it hits the short strike on your time spread, on the call side, you're talking about we did a long call time spread, and if it ever hits a short strike, you don't question it. You get out. You don't even look at, oh, gee, I only made a nickel or I made a buck. You don't talk about the profit. You don't even talk if it's a small loss. You just get out of the trade. And what happened was the underlying eventually got to the short strike, but it was very close to the expiration. And hence the reason why I want to talk a little bit about the trade. So as of yesterday was the first time, the last 2 days, Boeing has made a pretty big jump up. It closed on the 6th of July, and on that day it closed at 334, and then on the 10th of July the closing price was 347. So that's the big move that it made just over that short time frame. And I should mention that we are currently taping Options Playbook Radio on the 11th. It's a Wednesday. The markets are closed. So on the 11th, the market came back down, but we should have been out when it hit our short strike. We had the July 13th expiration, so that's going to be this coming up Friday. And once it hit it, we should have had an alert. We should have looked at it. Now, here's why I'm bringing this up is if you would have waited and you would have rode this trade all the way to the end, right now, that time spread, we paid $4.17 for it. It is now trading for $6.55. We're up over a couple of bucks on it. If you stayed this long, you probably would have got out maybe a little bit earlier just because it should have been, you should have been up at least a buck before that. So if you waited till long to this range and it actually hit that short strike of 345, which on a time spread, that's a good thing. And it did a fairly close to expiration. I would have probably rolled it. And so I actually grabbed the closing quotes from our internal site and looked at where the market closed at yesterday. And we had a 345 short July 13th call, and we were long the 345 July 27th call. And what I probably would have done looking at the markets is I would have bought to close the shorter expiration, the July 13th, and I would have turned this into a bull call spread. Which if we did that and we went out to the July 27th call on this underlying, we would see that we could have got this entire trade on for basically flat. And we would have had a 5-point wide bull call spread going into earnings for next to nothing. So I would have probably did that roll and, have zero risk on the table and rode Boeing into earnings. I have no opinion on Boeing whatsoever, but it's just the opportunity that was created because of the big move up over the last few days on this underlying and the fact that Boeing is going to be announcing earnings fairly soon here. So here's what the trade would be based off of the closing prices yesterday. We're just working off the midpoints here. So just keep that in mind. You can always fill directly at the midpoint. But if we would have closed out our short July 13th expiration call, the price was $4.40. We then could have bought that back and actually sold the 5-point higher strike price, the 350 strike call, for $8.35. Hence, bringing in about, I'm just going to round off, say $4 for this trade. And then we paid $4.17 for this trade at the midpoint when we first started it. So we'd be very close to being even on this underlying. The market is at $3.47. $3.47 is where it would have closed at yesterday. And you would have 5 points of upside going into earnings with the underlying market right at where your long strike is on your long call spread. So I just thought that was an interesting alternative. Obviously, you could have just taken your profit and run. There's nothing wrong with doing that at all. But a lot of times I really like calendars because you just get so many options and you don't even always know exactly what opportunities are going to arise until the moment that you plan to actually adjust that trade. So that's what always excites me about any calendar trade or any horizontal trade. Okay, so with that said, guess what? We're in earnings season, and we're officially there. Netflix right now is going to be announcing on Monday, the 16th, after the close. So I'm going to look at a Netflix trade. And once again, I'm going to change it up just a little bit. I like to look at trades that happen after earnings. And this week, I'm going to actually look at a butterfly that's going to happen before earnings. So if I look at this, it's just a little bit different. Netflix is a mover anyways. After earnings, Netflix right now is trading at $418.65. It could move at any point in time 20, 30 points. And after earnings right now, the expected move on the underlying is about $40. So if we look at the money call and the at the money put, that's what we're talking about. So I'm going to look at just what's going to happen before earnings. So we have an expiration on the 13th. It's just going to be a 2-day trade. It's going to be a very quick trade. We're going to go on the bull side. We're going to go a little bit bullish on this trade, and we're going to do a skip strike butterfly just on a 2-day trade. The expected move over the next 2 days is only $10. The expected move after the earnings is $40. So that's just showing you relative. And be using that information, that's going to help us pick out our strike. So the underlying market right now is at 418.65. Once again, it's the 11th of July. It's a Wednesday. The market has just closed. And the trade for this week, and we'll be able to review it quickly the next time that we come back and start talking about these strategies. Just because we had a 2-day trade. So we're going to be buying the 430 strike call, which is a little bit more than 10 points higher than where we're at. And it's going to have a lot of time decay in this underlying. And the main reason why I kind of like this trade a little bit is that it's a $418 stock. If it wasn't such a pricey stock, this wouldn't really be of interest to me because we're going to get a lot of time decay over Thursday and Friday. So let's set up the trade. So here we go. So using the July 13th expiration, which has just 2 full trading days before these options are going to expire, we're going to look to buy the 430 strike call, sell 2 of the 435 strike calls, and buy 1 of the 445 strike calls. So we have a 5-point wide spread, and then on the short spread side, we have a 10-point wide spread. So because of this, because we've got a little bit more risk on the upside, we can get this done for a net debit of 5 cents to the account. I would love to get it done for even or even a small credit, but we can't do that. I'm okay with just a nickel. So in this trade, if we are dead wrong and this market doesn't move 10 or 11 points to the upside before this expiration on Friday, well, the most that we can lose on this trade is 5 cents. If it does go up, the most that we can make on this trade is $5, less that 5 cents. That would mean that Netflix would stop right at 435. And then our risk really kicks in if the Netflix goes over 440 by that expiration date. That's the strike that we're actually skipping in the butterfly. And then we have 5 points of additional risk from 440 to 445. So just a short and sweet little skip strike butterfly, mixing it up a little bit, doing it before their earnings as opposed to doing it after their earnings. And that's going to be our trade for this week. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, please email me directly at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/the The Options Insider or via questions@theoptionsinsider.com.